The international finance world is in chaos. Donald Trump's trade war has put Wall Street in the red. But just when many people thought the worst was over, boom. It's not just the stock market anymore. The dollar and US government bonds are also faring worse and worse. To give just one example, the cost of the 30-year bond has risen to 4.94%. This is the largest weekly increase since 1982. And here you have to be very clear about one thing. The fact that debt yields are going up is not a good thing, but quite the opposite. It means that the US has to pay more money to the rest of the world in order to borrow. Or to put it another way, in this case, high yields means that the rest of the world no longer trusts you, and therefore asks for a higher return to compensate for the higher risk they perceive from the investment. Visualeconomik community, this is unprecedented. For the markets to fall, well, to some extent, that's normal. But US debt needs to gain from all this chaos, and that isn't happening. You see, US dollars and debt are the quintessential safe haven asset, an asset that does very well the more chaos there is around the world. Let me ask you a question. What do you think happened to the demand for US debt after the 9/11 attacks? Did it go up or down? Well, the truth is that it went up. The world began to demand US debt like there was no tomorrow to protect itself from all the uncertainty that was suddenly circulating around the world. Of course, this caused its cost to fall sharply. Remember, when it comes to debt, higher demand pushes up the price of bonds, and that drives down their yield. But this is not the craziest thing. When several credit rating agencies downgraded the US a few months ago, purchases of this debt also skyrocketed. Yes, I know this doesn't seem to make any sense. How is it possible that people are demanding more US debt just when it is announced that the US is an increasingly unreliable debtor? Well, again, the key is that the dollar and US government debt are the ultimate safe haven assets. If there's a storm, everyone seeks refuge in Uncle Sam's debt, and that's what should be happening right now. Not only that, but the tariffs should also be strengthening the dollar. The reason in this case is very simple to understand. Tariffs reduce trade with the rest of the world, and therefore reduce the demand for foreign currency. And of course, the same supply and less demand means that prices go down, and saying that the foreign currency goes down is exactly the same as saying that the dollar goes up. Even so, this situation has just changed.
Treasuries suddenly trade like risky assets, in warning to Trump. "We are being treated by global financial markets like a problematic emerging market," he said, adding that this could set off all kinds of vicious spirals, given government debts and deficits, and dependence on foreign purchasers.
It seems impossible, but what is happening in the US is more like what we usually see in Argentina, a full-fledged capital flight. Stocks, dollars, short and long-term treasury bonds. Everyone is selling their US assets. This is an unprecedented sign of weakness for US economic and financial power. The US represents 25% of the world's GDP, but 65% of the world's equity market. So we could well say that finance is the star industry of the USA, and now that industry is in danger. On this channel, we have talked many times about how most of the headlines like "the dollar is coming to an end" are pure clickbait, apocalyptic news without anything to back it up. But the truth is that these days, a step has been taken in that direction that, frankly, very few people expected. Trump is achieving what neither 9/11, nor the 2008 crisis, nor COVID could achieve. He's damaging the power and value of the dollar. And in this video, we'll tell you exactly why all this is happening, as well as answer other key questions. Are we talking about a temporary setback? Or are we witnessing the beginning of a change in the international order? Could this be Europe's great opportunity? Well, let's take a look. Visualeconomik community, this whole crisis has had one very clear cause: Donald Trump's tariff war. The occupant of the White House's obsession with closing the trade deficit has caused the rest of the world to sell off all types of US assets en masse. And let's see, I'm sure many of you have heard that this is a coordinated attack from China, but nothing could be further from the truth. What we're seeing is not an attack by a single player, but the result of the actions of millions of individual people around the world. In fact, the biggest beneficiary of all this chaos is not China, but Europe. The world needs a safe haven asset, and if the US is not able to deliver it, then the market is clear where to turn: to Germany. The spread between the US and German bonds has experienced its largest sudden jump in the last 40 years. Germany is the ideal choice. A large, very predictable economy with plenty of room for debt. It's true that right now, the whole of Europe is in the middle of an arms race that is going to be very painful for the public accounts. But Germany has been taking care of its fiscal balance for decades. Its debt to GDP ratio is 60%, half that of the US. So, as I said, there is plenty of room to maneuver. Of course, it's still too early to draw conclusions. Maybe in a couple of days the US market will recover, and in a few months, no one will remember this episode. What's more, Donald Trump is already backtracking on many of his tariffs. However, the problem is that you can't put all the toothpaste back into the tube once you've squeezed it out.
Our real concern is that while Trump may be able to cut a few tariff deals, when the issue is a broader loss of confidence in the United States, even a much fuller retreat on trade might not work.
Visualeconomik community, the problem is not the tariffs themselves. We've already explained it to you. Under normal conditions, tariffs would make the dollar stronger, and the opposite is happening. The real problem is that the US is an increasingly unreliable partner. With his surprise tariffs, his attacks, and his all-out threats, Donald Trump has not only sown distrust across the globe, he's also broken several free trade agreements and flouted the World Trade Organization's most disadvantaged nation clause. This clause obliges all countries to impose the same tariffs on all other countries with which it does not have a free trade agreement. In other words, that putting a different tariff on each country depending on your trade deficit, as Trump has done, clashes head-on with the spirit and rules of the World Trade Organization. In general, Trump is destroying the main asset that the US economy had, confidence, and now he's going to pay dearly for it.
If foreign investors do decide to continue retreating from U.S. assets, the pain could be substantial. They hold about $7 trillion in treasuries, $19 trillion of equities, and $5 trillion of corporate debt, accounting for about 20% to 30% of the total market.
But as if all this were not enough, the crisis of confidence in the US is already being felt in other markets beyond the stock market and government bonds. For example, check out the following graphs. European tourism in the US has plummeted, falling by 20 to 30% in many countries. And pay attention, we're not only talking about fewer flights, cancellations have also increased by 40%. Trump's immigration policies are starting to scare even Europeans, and that translates into more misgivings about anything to do with the US. It's a distrust that could also become established in the investment markets. Although, if this were to happen, many within the Trump administration would be delighted, because their goal is precisely to reduce foreign investment in the US. And why on earth do they want less investment? Well, to close trade deficits. But don't worry if you don't understand, because in a few days we'll publish a video explaining in detail the intellectual origin of all these ideas. For now, what you need to know is that many senior officials within the US model want to impose an even more extreme version of tariffs, moving from a tax on imports of goods to a tax on exports of financial assets. Or, to put it better, in a way, they want to impose capital controls. Exactly, just when Argentina is liberalizing, the US wants to become Peronist at full speed. This is another big risk that is causing everyone to dump their dollars, but it's not the only one. Another reason behind this capital flight may be that the market expects debt rates to rise in the future, and Donald Trump is also the main culprit of this. The Republican president came into the White House promising that Elon Musk was going to balance the budget, but the federal government is spending more money than ever before in all of history, and the deficit is getting bigger and bigger every day. In fact, while DOGE is unable to tackle the deficit and is having disappointing results, Trump has promised to increase the military budget and lower taxes. And what does this larger deficit imply? Well, we saw it perfectly in the pandemic: inflation. And the formula for fighting inflation we also saw during the pandemic: for the Federal Reserve to raise interest rates. For the time being, the Fed has corrected its inflation forecast upwards for the coming months, which is much closer to 3% than to 2%. And its chairman, Jerome Powell, has made it clear that his job is to keep inflation in check, and that he will do whatever it takes to achieve that goal. Come on, he's saying that the Fed is in no hurry to keep lowering interest rates. And who knows, even if it seems crazy now, maybe the Fed will even raise them again in the future. For the time being, the Fed has already announced that it does not plan to make emergency cuts to ease the market, and that a rate cut is not in the toolbox that they plan to use to stabilize this situation. In fact, right now, the only thing that can avoid this scenario would be an even worse one: a recession. But wait a moment, because we may be jumping the gun. Not everyone believes that this capital flight is due to structural problems in the US.
I believe that there is nothing systemic about this. I think that it is an uncomfortable but normal deleveraging that's going on in the bond market.
And yes, I know, the Secretary of Treasury is not the most impartial person in the world, but he might be right. But before I explain why, let me introduce you to one of the protagonists of this story, basis trade. Basis trade is a financial strategy that arbitrages between the price of an asset and the price of its future. Normally, the futures of an asset, such as government bonds, are more expensive than their price today. Well, if this is the case, then there's a way to guarantee that you will somehow always make money. Let's assume that the debt is trading at $1,000 today, and at $1,200 its future in 1 year. So if you buy that debt today and sell a contract in the future, whatever happens to the price of the debt, what you gain on one transaction, you will lose on the other. For example, if after 1 year the debt is worth $1,100, then you will earn $100 with the spot purchase you made, and you will lose $100 with the sale of the future. This will always cancel out, but you will still have the $200 you earned with the difference between the spot and the future. Seriously, guaranteed profit. It almost feels like magic. But of course, things are never as straightforward as they seem. This method has two major problems. The first is that the difference between the spot price and the future price of these assets is usually extremely small, so it's very difficult to make a return. The solution? Leverage. Taking on debt to be able to invest so much money that even if the return is small, the absolute benefits are large. And take note, because we're talking about using between 50 and 100 times more debt than equity, which is really crazy. But there's a second problem, that you have to wait a while to guarantee profits. And if during that time rate expectations change a lot, then you expose yourself to big losses. In that case, if you sense that risk, you may prefer to sell and unwind the position, let alone if you suddenly need liquidity, in other words, money, then you would have to sell as quickly as possible. And Visualeconomik community, this is exactly what has been happening with US debt. A liquidity crisis has forced hedge funds to unwind their positions, and not surprisingly, since they are so leveraged, then the losses have been brutal. As you are seeing on the screen, the gap between interest rates on collateralized and uncollateralized loans has suddenly become very positive. This means that it is cheaper to borrow if you do not offer public debt as collateral than if you do. And the reason is what we've just told you. People don't trust that the other party will keep its promise to collateralize their loan because there is a liquidity crisis and a lot of positions are being closed. So yes, the Treasury Secretary is correct in saying that there's a financial movement against the dollar and US debt. But of course the question is, what is causing this movement? Well, it may be mere speculation, but let's be honest. If it has happened just now, it's because the market sees a real risk in US debt. Besant says there's no systematic problem, but merely a financial movement. But the reality is that there's a financial movement precisely because there is a systematic problem, and that problem is the global loss of confidence. Keep in mind, Visualeconomik community, trust is something that takes decades to earn, but can be lost in a single day. Of course, this is not bad for everyone. As the saying goes, the wise take advantage of turmoil. This is Europe's golden opportunity to lay its cards on the table and give the world what the US cannot. A secure asset based on a strong economy, respect for institutions, and free trade based on international rules. Unfortunately, the euro has its own problems, as we've already told you several times on this channel. Be that as it may, what is clear is that if things don't change, we will be heading towards a much more multipolar world where there will not be one big currency dominating the market, as is the case today. This may be better or worse to you, but what is clear is that the road to this new international order will be very painful, and not only for the United States, but particularly for developing countries. Anyway, let's hope that the US returns to its usual course. The damage has already been done, and these events will take time to be forgotten, but there's still time to avoid the worst of this capital flight. But having got this far, now it's your turn. Do you think tariffs are to blame, or is the market reacting to a more fundamental shift? Will Europe become the world's new safe haven, or will we see the US take the bull by the horns again? You can leave me your answers down in the comments. And as always, don't forget that here on Visualeconomik, we release new videos every week, so subscribe to this channel and hit the little bell so you don't miss any of our updates. If you like the video, like it, and I'll see you in the next one. All the best. See you next time.